Hey everyone, welcome back. Today I'm taking a closer look at Google's parent company Alphabet, GOOGL for Class A shares and GOOG for Class C shares. Alphabet has always dominated the search engine and advertising for many years. But what really excites me about this company is their AI research, their YouTube growth, and their other emerging businesses like Waymo, which I believe is going to play a very big role in the coming 5 to 10 years for this company. Unlike the other stocks in Max 7 like Nvidia, Tesla, Apple, you name it, Google sometimes does not get the same love and is often overlooked by a lot of investors. Also, Google is part of my top 5 stocks of 2025. The goal of this video will be to look into Google's financial health, their revenue model, their price targets, their technical analysis, what is my position in Google. And if you enjoyed today's video, make sure to give us a like, share it with as many people as possible. And without further ado, let's dive in. Google is trading at $181.58 at the time of this recording. The stock was down $5.06, which was about 2.7% on Friday because the general market took a hit. Year to date, the stock is down 4.65%, but in the last 1 year comparison, we were up 26.24%. The stock is a $2.2 trillion company, and don't forget, they also pay you a dividend of 80 cents. They reported earnings on February 4th, and they had a top line beat, but they missed the bottom line. Generally, in Max 7, we see a much better performance. However, when it comes to Google in 2022, they had a miss on both top line and bottom line for 3 consecutive quarters. So keep in mind, among the other Max 7s like Apple and Microsofts of the world, Google has missed their earnings many times. The next earnings will come out in May, and unfortunately, we have a down revision on the EPS. You see 2.15, they are projecting to have a EPS of 2.02, and the revenue which came out to be 96, we are expecting a revenue of 89, and that's why you see down revisions by so many analysts. If you missed the latest earnings, here are a couple highlights. The Alphabet Q4 2024 revenue increased 12% year over year, so that's a good sign. The Google services revenue also went up 10%, reflecting to 84 billion. But what really excites me is the Google Cloud revenue increased 30% to 12 billion. Now this was primarily led because of the AI infrastructure and generative AI solution. Among the cloud providers, the big three are Amazon's AWS, Microsoft's Azure, and Google Cloud. But between the three and being in the SaaS market for so long, what I have at least noticed and observed, generally the default cloud provider always is Amazon because of the economies of scale for most companies, and then they go to Microsoft Azure, and then the third option is generally the Google Cloud. But what we are seeing a shift here is as the AI infrastructure is getting built more and more, and companies are spending more money on these products and services, the AI infrastructure is leading to a massive growth in Google Cloud. And this is where I'm very positive that in the coming years, Google Cloud will become a much bigger player in the cloud computing space. We also saw total operating income increase by 31% and the net income increasing by 28%. However, we may see a little bit decline in the next quarter because of the capex increase recently. They expect to invest about $75 billion in capital expenditure in 2025. So that is, of course, going to play a role in your earnings since your expenses are going to increase tremendously. But what this does is it provides Google a lot of bandwidth and infrastructure build out that they are going to build more products and services and bring it to the market and be able to monetize it much faster than some of its other peers. But this is a trend that we are seeing across the board, especially for Max 7. We see Amazon also announcing it, Meta also announcing the capex expenditure along with Google. Diving a little bit deeper into the financials, we see a constant growth in their revenue across every single quarter, and we see a similar trend in the gross profit. This is how the financials should always look like. Their operating income was tremendously up in the last quarter. It may go down further in the coming quarter, so keep that in mind. The net income was flat from the last 2 quarters, bringing in about $26 billion plus. When you look at the balance sheet of Google, this is one of the best financial balance sheets you can find in across any industry. This company has $20 billion in free cash flow, not something something many companies can boast. Even companies like Apple has less than 20 billions in free cash flow. Let's spend a little bit more time on understanding the revenue and expense breakdown, because generally when a company of this size, it is important to understand where they are spending their money on, because that is very important for the future growth of the company. We talked about how Google brings in about $300 billion in Google services. They bring about 43 billion in Google Cloud, a relatively smaller portion from the revenue size. And then the other bets bring in about 1.65 billion, which includes businesses like Waymo, which I believe if it can scale up in the coming 10 years or so, this would become a very, very big bet for Google. The total revenue is about $350 billion and the cost of sales is $146 billion. When you look at the gross profit of $203 billion, they are spending 50% almost on the expenses. And within that expenses, you have the general and administrative, they're only spending about 14% on non-operational expenses. Sales and marketing gets about 28%, but the majority of the expense goes towards R&D. And this is a very good sign that the company is continuing to invest more in R&D, because that is where they will come out with more products and services to help the revenue grow at a much larger scale. I like these balance sheet a lot, and specifically where they are spending majority of their money. Right now, the stock is 30% undervalued from its fair value, which is $259.60. Now, if you do your own DCF analysis, you may come up with a different fair value number. But overall, right now, seems like based on the revenue the company is bringing, the stock is relatively undervalued. And this is why it is part of my 2025, not just trading standpoint, but from a long-term investment standpoint. When I said earlier that it does not get the same love as some of the other companies in the Max 7, look at their price to earning ratio versus its peers. You're paying 20 times the earning for Alphabet, whereas for Amazon, you're paying 34.2, Apple 32.6, Microsoft 28.9, and Meta 27.2. Nvidia is around the 30 as well, and let's not even talk about Tesla from an earning standpoint. But as you can see, among these big companies and big titans, Alphabet is relatively very undervalued and deserves a lot more love compared to some of its peers. Considering the company is a $2 trillion company, the growth is also astounding. It is in double digits. In 2025 December, we expect a year-over-year growth of 11.43%. 2026, we are expecting close to 11%. Till 2030, we are expecting growth rate of anywhere between 10 to 11% consistently year over year for a company of this magnitude and size. Wall Street also has a very similar opinion on the stock. We have 38 strong buys, we have 15 buys, and there are 12 holds. There is 0 sell ratings. Analysts are expecting an average price target of 280, which gives you an upside potential of 20.45%. If you are going to be investing in Google, there are some risks that you have to take into account, or which could impact the price of the stock. Number one is, of course, the regulatory and antitrust scrutiny. Considering the size of the company, considering the business they are in, Google is often hit with these kind of lawsuits across the world. EU specifically is very strict when it comes to their GDPR laws, and Google often finds itself in the crosshairs all the time. US side, we have a new administration that is relatively looking easier on the companies. Deregulation looks highly likely on the cards. That may help the company in the coming 4 years in the US market, but for the other countries and other segments of the world, this could continue to be an issue. The number two risk in investing in Google is the competition in AI. Microsoft, OpenAI, Meta, Nvidia, Tesla, all these companies are getting very heavy investments into the AI because AI is the next frontier. So Google will not just be able to completely take over the market. You will have all these other major players also having a big role to play. DeepSeek, which is a Chinese AI which showed the world that you could build AI at a cheaper cost, has also impacted the way we look at AI in general, and especially for markets that are Africa, Southeast Asia, South Asia, which could prove to be a next battleground, because then you will have also players from China that will be operating at a much lower cost than the US peers. The third risk that I see personally is the other bets that we have. So for example, Waymo is one of the other bets for Google. As of right now, it looks highly likely that Waymo will continue to succeed because they were operating very successfully in California. They moved to Florida. They are going to Austin this year and then later into Atlanta. However, these bets may not be able to scale and bring enough revenue, which is sizable in nature, but continue to spend a lot more money. And some of the other bets bets in the life sciences may never pay out for Google, and that's also okay. But those are some of the main risks that you have to take into account when you're investing in a company like Google. This is the daily chart for Google. We had this gap up back in December after the dividend announcement, and the stock had continuously run up, making higher highs. Based on the recent drop after they reported earnings, and market was a little bit spooked out when they heard that Google is going to put $75 billion in the capex for 2025. So we saw this gap down, and since then the stock has continuously trended downwards. We did see a little bit of this gap fill happening here, especially on the Friday trading, which is a bearish signal at the daily level. Whereas when we switch to the weekly, we saw a continuous uptrend since September of last year, but the last 3 weeks after the earnings announcement, Google has seen a downtrend from a weekly standpoint as well. Now back on the daily, Google is slightly below its 100-day moving average, which is 182.16. So if we see further weaknesses, we could see a support coming out around the 200-day moving average of 176, where we also see some more volume shelf right here, where this could be acting as a good support level for Google if we see weakness. What I would like to see is for this gap fill to occur, and then we can see a bounce from the 200-day moving average back to the top. However, that will also depend on how the overall broader market is playing. I'm not very bearish on Google because on a weekly, we are still above all its moving averages, and generally this just indicates a small pullback rather than a full breakdown or complete reversal of the trend. Considering the weekly chart has not really shown us that we are completely breaking down and we are still above its major SMAs, I'm fairly optimistic that we will probably see a bounce from the 200-day moving average on the daily chart. As we talked about, the fair value of the stock is $259. The stock is trading at $181. Even if you do your own DCF analysis and you come up with a completely different number, we still have a good upside of 42%. The price target that analysts are talking about is $218.72, which will give you a good upside of 20% or so. So overall, from this level, if you want to invest in Google for a long term, 218 could be your first target, where we would be 20% up, and I'm targeting the fair value, which is the 259. So overall, I really like where the Google is. I will be watching this level very closely, especially for this gap fill to occur and probably a bounce from the 200-day moving average. This is my current position on Google. I added the stock on February 7th, right after the earnings was reported. I am down about 5% or so. Overall, I love Google in the Mag 7 space, and this is really one of the most undervalued plays that you can actually add to your portfolio. If you are investing for a long term, dollar cost averaging at major levels is important. So if the stock continues to trend downwards and you see the stock coming to the 200-day moving average, you should be adding more to your portfolio. If you like to add stocks from an option standpoint, where we love to sell options, I would look at a 21st March expiration 321 targeting $175, which would be the 30 delta. And the reason is because 176.97 is your 200-day moving average. So I don't mind adding the stock at $1 cheaper. And you will get about $264 on the $175, which lowers your cost basis to $172 and change. This is a great place to be adding Google in your portfolio for long term. If you're looking for much shorter term turnarounds, I would target maybe 177.5 for the next week expiration, which will be 27 delta. It will give you 97 cents. So that drops your cost basis to 176 and change. That's my take on Google, a proven ad machine and a major AI player in the space. If you found this analysis helpful, drop a comment below and tell me your thoughts about Google. And if you enjoyed today's video, make sure to give us a like, click on subscribe and ring that bell notification. I will see you next time, Investor Family. Happy investing.